All right. So the first thing you want to do when you're looking at the markets, guys, you want to get the structure of the market. Okay. So we want to understand market structure for directional purposes. Okay. So all of market structure, what's going to be important is that you understand break of structure, right? Now, when you understand break of structure, also known as BOS, this tells you the direction of the market. Like, this gives you the bias of the market. Okay, if price is going down, price is going up. Okay, so we want to be able to identify first the break of structure in the market, right? And I'm gonna give you guys some tools that will be able to assist you in this process as well. As you, like I said, I highly recommend you learn it, okay, so that you know it, and then you can add the tools on top of it. Okay, so let's talk this first. We're going to talk vertical structure first. And just like everything else, every other session, we are going to tie it together. All right. As let me ask this question: has anyone been having trouble with their entries? All right. It's a two-part question. Has anyone been having trouble with their entries? And two, would anyone like to get better entries into the market? All right. So it's two-part. All right. So you can say yes, yes, or yes, no, yes times two. All right, that's good. All right. Okay, perfect. All right. So you get in trouble with entries, you want to get better entries in the market, right? Because it's two things, when you're trading, it's one thing to get an entry in the market, then it's another thing to get an entry with a reduced risk in the market, right? Because if you reduce your risk, you increase your reward immediately. Okay. Reduce your risk, you increase your reward immediately. Okay, perfect. Someone says staying in a trade. Okay, good. We're gonna talk about that as well. All right. This is exits. All right. So, most people have problems with their entries and then also problems with their exits. So we're gonna get to exits as well. Okay, so no process here, right? So I'm gonna take you guys. So just follow me along on this journey, as you guys know, man, as usual. Okay. So market structure, right? So first thing we're talking is market structure. Okay. BOS, also known as break of structure. Okay. All right. So let's break it down, and we're gonna break it down pretty quick. Okay. We're gonna break it down pretty quick. All right, so we're looking at it from a downtrend perspective. So the market is going down, okay? All right, so we know this is the actual flow of the market. It's made up of an impulse, a correction, and a continuation. All right, you'll see this three-part move every single time, okay? So it's made up of an impulse, a correction, and a continuation. If you don't believe me, it's right here. All right, an impulse, a correction, and a continuation. Okay, boom. If you still don't believe me, all right, impulse, correction, and a continuation. All right, everybody seeing that? All right, impulse, correction, and a continuation. Okay, can we all see this? We agree? It's there. It's clear. All right, we don't gotta make it up. As to if it's there or not, we can see it. All right. Happens over and over. Perfect. Good stuff. All right. So I need to convince you guys of that. That is how the market moves. So if you understand and remember that this is how the market moves, then life becomes simple. Okay. So it's impulse, it's a correction, and it's a continuation. All right. Now, every time price breaks a low in the market, all right. Every time price breaks a low in the market, or if it's a high, right? It will be considered to be a break of structure. So for example, all right, let's say this didn't happen as yet. We got our impulse, we got our correction, then we see price coming down, and it breaks below this low point right here. Boom. All right, we got price breaking below that low point. Okay. As soon as when price breaks that low point, right, breaks and closes, right? You want to see a candle close below that low point. It is considered to be a break of structure, right? Because we call that BOS. Yeah. So break of structure. So of course, if it was to the upside, if we see this, this, right here, this would be considered to be your break of structure. Everybody follow me? You see the chart if you're all clear? All right. You see in the chart if you're all clear. Perfect. Good stuff. All right. Okay, good. So that break of structure indicates to us that price is more than likely going to continue to go down, right? So what do we expect? We expect after price breaks the structure for it to give us another correction and then another continuation. And guess what? Right? When we get this second break of structure, this is what would be considered to be a trend continuation, right? So price is continuing, right, in that downtrend, right? So perfect. That's what we want to see. Okay. So we get that trend continuation is like a strengthened, right? It's like indicating that yes, it is a strong or stronger downtrend. Okay. So we get that break of structure once again to the downside, then we pull back up, and then we go down. All right, once again. All right. So the first thing is the break of structure. It helps us identify, right? Helps us identify, the direction the market is going in. Now, when price does something looking like this, right? So we don't go ahead and create lower lows, right? So we know a downtrend is where the market creates these lower lows and lower highs, okay? So this is a low, this becomes a lower low, this becomes a lower low. So this low is lower than this low is lower than this low, all right? This was a high. This high right here is lower than this high, so we call that lower high. This high is lower than this high, call that a lower high, and this low, right, potentially could be lower than this high, and we would call that a lower high. Now, let's say, for example, that does not happen. Price comes up, and it does like this, right? It breaks past this area right here, right? What do we call this, guys? Price breaks above this area here. What do we call this? All right. All right, that was the trick question, right? So yes, we call this a change of character, right? Change of character. All right, so you see some persons are being plugging in. All right, don't worry if you're hearing this for the first time, right? What is a change of character? A change of character is your first indication that price could shift, right? It's your first indication that price could change direction. It's not the first, it's not a confirmation. It's like my first indication. It's like heads up, price could shift direction. Okay. That's the first indication. So we pay attention to this. Okay. Then price comes back down, right? Giving us the same type of structure we've been talking about where we got impulse, correction, right? And remember at this point, it's not a confirmation as yet, right? It's the first indication, okay? And what we're looking for is for price to hold. We're looking for price not to break this low, right? Now, if for whatever reason you get that because it happens, quite frankly, all right, you see something looking like this where price breaks the high, price breaks the low. At this point, this is where some confusion takes place. Right? In simple terms, this is where some confusion in the market takes place, and you gotta wait for confirmation, right, before you do anything, right? But we're gonna get there in time. So let's just say comes here, and we create a higher low, right? So we got the break above, right? Then we create a higher low, then and only then when price does like this and breaks this high, this is now considered to be, tell me, what is this considered to be? When price breaks the high now, what is this considered to be? Perfect. It's considered to be a break of structure. Perfect, right? So you guys following, okay? So simple principles. I want you guys to gather, okay? So only when, because no, right, we're not continuing the trend. This is where we now get reversals in the market. Okay, so this is where you get a reversal, Janelle. Yeah. So this is where price is changing direction. Okay. So change in character is like market switch up, right? We went through on the last session. It's where you get like the first indication, okay, you're looking to do something different. Market pulls back down, then it breaks higher. Now we get the break of structure, which tells us we have officially shifted direction. We have changed from a downtrend to a uptrend. Okay. And then we confirm this, of course, right? Remember trend continuation with the market creating a higher low, and then we create higher heights. All right. And each time, boom, that would be your breaker structure. And this is where, we get that shift in the market. All right. So always remember market structure, breaker structure, and a change of character. Okay. Character. That look a little funny. All right, guys? Yeah, look right. Right. Perfect. MS Forex, not English class. Yeah. All right. So you guys know. So break the structure, we gotta change the character. Okay. So we know what the two are now. Everybody's clear on that. Okay. So you got the break of structure in the market, we got the change of character as well. Break of structure is the confirmation. Okay. When we get a break of structure, that is the confirmation. All right. So we're gonna take this in steps. Okay. So I'm gonna clear this. Trust that everybody has this. Yeah, I'm gonna clear it. Boom. All right. No, let's break it down. All right. Make it very practical immediately. All right. So let's just say, for example, this is where we're at. Boom, we got price creating highs, all right? Higher lows, higher highs, higher lows, all right? Higher highs, right? And then we got this created right here. Boom. All right. We got a higher low being created. But guess what? What didn't happen, guys? What didn't happen at this point? Remember, we're in the uptrend. All right. What didn't happen at this point? Talk to me in the chat. Tell me what didn't happen next. No higher high. Perfect, Stephanie. Right? It didn't break the high. Perfect. So you see price came up. It didn't come up here and break this high. Right? So we see every time we had a break of structure. Boom, a break of structure. Boom. Right? But here, no break of structure. Okay? You guys seeing this? There's no break of structure. All right? So all right, price creating a lower high. This is also like a first indication. All right, this is also like a first indication. Okay, something's looking to happen here. It's not confirmed or anything as yet, but something's looking to happen here. Right, and then price does like this. Boom, pushes down. All right, we break this low. Okay, we break this low. Okay, now and maybe also break this low. All right, also break this low. So at this point, right, price taking out this low, price taking out this low, and coming back up, all right, we started to see how we started to get that shift in the market. All right. Some individuals, they may call it head and shoulder pattern, these different things. All right. I want you guys to grasp the concept of it. All right. It is just a structure break. Whether you see it as a head and shoulder pattern, whatever you see it as, it is just price breaking structure, right? So for example, all right, you may see two types of patterns whenever the market is looking to switch direction, right? It's called a head and shoulder pattern, which may look something like this, right? Okay, so this will be like referred to as the left shoulder. This would be your head. This would be your right shoulder, right? And when you see this happening in the market, typically that's when you start to see a reversal in the market. Same thing on the flip side, okay? Or as you may see the market coming down like this, come like this, push lower, come back up, do like that, and then go back up to the upside, okay? These are what you will call reversal patterns, okay? Now, uh, understand this, yes, it is a pattern, but please understand because it's not going to look this perfect every time, right? Understand it is just price breaking structure, okay? And once you understand that it's price breaking structure, then it's going to be simple to identify at any given point. Okay. So remember, we're looking for price to break structure. This was our higher low. This was our higher high. Then we didn't really confirm a higher low, yeah, because market didn't create a higher high. So this right here would be price, right, breaking, right? This would be price really breaking down, below this higher low. Okay, so this will be our change of character at this point. Yeah, everybody following? Right? When price broke below this low, this would be our change of character. Of course, this was our first indication in the market here, but this would be our first change of character here. Okay. And then we got price created lower highs. So here, boom, boom, right? So this was a high, lower high, lower high. Then we created a lower low, right? Boom, break a structure. Yeah. Break a structure, and now we know, boom, we are in for that downside movement. Okay, everybody follow? All right, same thing we literally just went through. I just applied it to the chart. Okay, same thing we just went through. We just applied it to the chart. Does anybody need me to go over that? Anybody need me to go over it? Okay, cool. All right. So remember, structure. Remember, same thing we're looking at. Market creating higher highs, higher lows, higher highs, higher lows. Okay. Each time price is going to break structure. Okay. So for example, we see here, let's call this a low. This made it, this was a high. That was a higher low. That was a higher high. That was a higher low. That was a higher high, higher low, higher high. All right, let's take it here. Higher low, higher high. All right. Boom, higher low. Well, higher low in the making. Okay. And then price didn't create higher highs. Okay. So price didn't go up and break structure. So when we see that price doesn't go ahead, and break higher, then immediately what that says to us is that, okay, pay attention to the market. Something is about to change. Okay. And that's when get skeptical about the market. Right? Get skeptical. You say, all right, let me see what you're gonna do now. Right? Let me see what you're gonna do. Okay. Because, granted, this could have just done like this, boom, and then go higher, right? Granted, yeah. But we just paying attention to what is the market is going to give us, yeah. So this was really and truly our last higher low here, okay? Because this was the last low, or higher low rather, that created the higher high. Does everybody follow that? All right, this is the last higher low that created the last higher high, okay? So really and truly, this is our external structure. This is structure that we really want to see broken. Yeah, this is structure we really want to see broken. Perfect. All right. Price came down. Boom. Broke that. Perfect. All right. Spectacular. That is what we want to see. Right. First indication. Okay. Then market pulls back up. All right. Remember, no, we shift now from uptrend, from creating higher highs and higher lows to no, creating lower lows and lower highs. Okay. So now we haven't created any higher highs. Remember up here, this would be our break of structure. Price didn't break past that. Okay. We pushed down. We started to push down. The momentum starting to shift. Okay. So now we see price drop lower now. Bam. Right. Breaking structure. Okay. We creating now lower lows, right? And lower highs. All right. So lows, yeah, lower lows, we got lower highs, we got lower highs, we got lower highs being created. So we can see the shift, right, in the market from an uptrend to a downtrend. Okay, everybody following me now? All right, you see price shifting from an uptrend to a downtrend. Okay, you see it? Okay, good. Okay, perfect. All right, Janelle, it's all clear? Better? Yeah. Okay, good stuff. Perfect. All right. So that is how structure is formed. That's how we get changes in structure as well. All right. That's how we get a shift in structure. So that's the difference really. Immediately we can look and see, okay, well, this is the difference between a correction and a reversal, right? We could clearly see the difference between a correction and a reversal, right? We know that these pullbacks here, right? We know that these pullbacks. Let's clear it. All right. We know that all these pullbacks are just corrections in the market. All right. All these pullbacks are just corrections in the market. And we know when price stops like creating those higher highs or stops following a particular trend, that's when we know, the shift in trend is basically going to start to happen. Okay. So we know that this. All right. This right here, this pullback, all right, or what it would call a correction, it is valid once price stays above the um the actual impulse, all right, where the impulse began. Okay. So always remember this, all of this would just be a pullback. All of this would just be a correction, right? Once price doesn't break below where it originated from. Okay. All this would just be a correction. Even if price comes 100% back down and then goes back up, all right, valid. Okay. It's a valid pullback. Okay. Once this could happen, you know what I mean? It's a valid pullback. We still valid for higher highs, all right? Still valid for higher highs. So you're still looking for price to keep going up. It's when price does like this, boom, and breaks below now. That's when we get that change in character. That's when you should be, like what it says, skeptical of the market. No, right? And you just look at the market through the lens of it has to create, that impulse correction continuation. Once you look for that, then it makes life simple. Okay. All right. So we understand the structure. We understand how the market moves. All right. Now, what we want to look for, all right? Now because the way that we look at the markets is the way that the banks look at the markets. Okay, guys. So the way that the banks look at the markets is called we call it smart money. Okay, banks are the smart money. The major institutions, they're the smart money in the market. Okay, the average retail traders, that's dumb money. Okay, it's small money. So you trade and look at the market through the lens of smart money concepts, all right, through the lens of the way that the banks look at the market, all right. So, I mean, of course, many individuals have different ways and perspectives of looking at the market. Uh, this is the way that I look at the market, right? And it just makes sense, in my opinion, to trade the way that the banks are trading. Okay. It reduces one, the risk, increases the reward, and you are moving with the persons that are moving the markets, right? And why wouldn't I want to trade like how the banks are trading if they're the persons in control of the markets, right? That makes sense? I think so. So, next thing that we're looking for, we start to look for what is known as a fair value gap, also known as, all right, let me type it out. All right, a fair value gap, right? Also known as simple terms, also known as imbalance. Okay, same thing, right? Uh, so basically, what it is when price has traded inefficient to one side. Okay. So for example, here it's like where we just have sellers, like for example, within this area, there were no buyers. Okay. So price was inefficient with the buy side. Okay. It was buy side inefficient. Okay. So you see here, boom, just sellers, right? Just sellers, just sellers, just sellers, just sellers. Okay. Um, yeah, yeah. Top-down analysis, basically, yes. So this literally how you look at the market through one, the structure, and then you start to literally identify the imbalance in the market. You start to identify where the gaps in the market. All right. So you want to look at where do we have, price just selling or price just buying based on what it is that you're looking to do in the market, right? Like here we identify, for example, that price shifted from buys here to then sells. All right. So if you're looking here, we're looking for, okay, where is price imbalance? All right. Where is the market not balanced back out? And why do we want to do that? Because remember, always remember this, the market is always trying to rebalance itself. If the market is always trying to rebalance itself, then we need to find the areas where it has been imbalanced. All right, because we can use those areas as target areas. Those are areas now where you can start to pick entries and so forth in the market, right? And like it just makes life simple, guys, in my opinion. Okay. So we start to look for where price is imbalanced. Okay. We start to look for where price is imbalanced. Now, before I actually go here, right, I want to give you guys a tool that you can use that can help you identify, breaks the structure, change the character, but like I said, all right, please, 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 please know it for yourself first. Okay, please know it for yourself first so that any tool doesn't confuse you because you know it for you. Okay, so for example, this one is called market structure, right? So you can go here and type in market structure, right? Go to your indicators, right? And type in market structure. You see it right here. I'll forever say I don't like the name, right? But yeah, right. Market structure. We need to find a different name, guys. Yeah. Um, but yeah. So it shows you, as you guys can see, the higher highs, the higher lows, right? The lower lows, the lower highs, the lower lows, the lower highs. Also shows you the where it's a structure. Boom, boom, boom. Right? Bam. Yeah. Shows you where price broke structure. Okay. And it's a good assist. Okay. It's a good assist. Okay. Yeah, you change that for sure. We can find a different one though. All right. We're gonna find a different one for sure. All right. I use it with something else though. So maybe you could use as a replacement because I actually seldomly turn this on, to be honest. All right. I use this one right here. All right. It just comes with more. Yeah, it just comes with more on the screen. Okay. And I'll explain this in a bit as well. Okay. So there's one thing at a time though. So right now, this shows you basic structure. Okay. The breaker structure, the higher lows, the higher highs, and so on and so forth. Everybody got that? All right. You can add that as an indicator on your chart and it just make your life a little simpler. Okay, you see, it shows you the lower lows, the lower highs, etc. Show you where price broke. The structure, same thing that we literally just went through. Everybody clear? All right, same thing we just went through. Okay, all right, good. Oh, perfect. So next thing, like I mentioned, though, was the fair value gaps. All right, no, when price is moving in one direction, okay, which is any impulse, all right? Boom, any impulsive move, all right? Always remember this. And this is why I go over this over and over and over and over and over. Some of you probably are tired hearing this at this point, all right? But if you understand it, you will have better entries. All right? You will have better entries in the market, right? You will stop entering the market too early and being in unnecessary drawdown. Like it just helps. Okay. So right, for example, if we got an impulsive move like this, boom, what is going to follow? Somebody tell me what follows after impulsive move. I don't want you to just know it. I want you to really understand it. All right, a correction follows. Look, Correction follows. A correction always follow. No, listen, that don't matter if it is a breakout. It don't matter, like if the market structure changed. It don't matter if price change from a reversal to from a continuation to a reversal. Expect, right? Expect the market to pull back, right? So, for example, okay, like here, boom, price took this low, okay, price took the low, boom, it sold off. Somebody said, your CHF is selling, jump in to sell. Absolutely not, right? That is how you get perfect entries in the wrong direction, right? Because no, you see price dropped here, right? 1 hour time frame, boom, candle closed right here. You jump in the market for a sell. You got the perfect entry in the wrong direction. Market pull back up. You shouldn't be surprised, right? You shouldn't be surprised at that point because after every impulse comes what, guys? After every impulse comes what? Correction, right? So in rocket science, right, that the market pull back up. Yeah. Yes, you got the indication that price is going to break below. Great, right? But jumping in the market, at these points, tend to put you in a significant drawdown. That's why personally, I know some persons do it, but personally, that's why I don't like. I personally don't like break and retest days. Right? But I personally don't. Yeah. Why? It puts you in unnecessary drawdown. Okay, like yeah. That's it's just the fact of the matter, right? It's just the fact of the matter, to be quite honest, right? I don't like it because it puts you on unnecessary drawdown. I could have entered this trade, but up here it just calls for more patience, less partake. Okay, because I'm gonna be in a trade at this point, then the market pulls all the way back up, but then continue down. You know, we don't want that. All right, we don't want that. All right, so that's what he said. This is the advantage of trading smart money. All right, because yes, it requires more patience. Yes, sometimes you could miss some entries. Yeah, it happens as well. Okay, but when you do get it, trust and believe. You're gonna smile from no till that trade hits TP. Okay, so after every pull impulse comes a correction. Now, why? Right? I'm gonna help you to understand why. Why does that happen? Because the impulse creates inefficiency. The impulse creates imbalance. The impulse creates fair value gaps. Okay, the impulse creates fair value gaps. Okay, the impulse creates imbalance in the market. All right, so it's an impulsive move, it's a aggressive move, and as a result, it creates those imbalances in the market. Okay, so um, let's see. I want to show you. Let's see if it pulls up. All right, perfect. All right, so you can see here now. So this stochastic indicator I'm going to give you, it helps. eh, So it shows a few things. Okay, it shows a few things. I'm gonna break it down. Okay, it shows a few things. So you're gonna see it shows internal structure, right? It shows you swing structure. It shows you order blocks. All right, we're gonna get to those things, right? So right now, I just want you to focus here on this, right? Fair value gaps. That's it. I just want you to focus on fair value gaps. Okay. This extend FVG, the number that you input here, just shows you how it just brings it wider, right? It just shows brings it out further. So, for example, if I had to put this at 50, you see it extend further to the right. All right, you guys see that? Okay, I just don't want it that much. All right, so I got it at like 33. All right, you can put whatever number you want. Okay. And then the time frame that you want to see it on, I just have it on chart so that whatever time frame I go on, it pulls it up there. Okay. So this shows you where the inefficiency in price is. It shows you where the imbalance in the market is. Okay. So makes life simple once again. Okay. So all we're looking at, I don't want you to pay attention to anything else, just pay attention to the imbalance. Okay. So all we're looking at is, okay, where is the imbalance created in the market? All right. So here we can clearly see imbalance was created at this point. Okay. So imbalance was here. Of course, imbalance is also here, right? We could clearly see that for those of you that know, right? But this is the imbalance right here in the market, right? Price is attracted to imbalance. Remember that, okay? So for example, right, and this is called Lux Algo Smart Money Concepts, all right? So if you go to your indicator, you type in smart money, all right, type in smart money, and you see it here, Lux Algo, okay? So I give you guys two things that can help you, all right, make life simpler for you, okay? Um, It also has a number of other things incorporated in it, right? So you'll see it shows you equal highs, it shows you change of character, it shows you break of structure. All of that literally is in this. Okay. All right. But I just want you to focus on this one thing for now. We'll be taking it in steps. Okay. So you'll see, for example, price returns to the imbalance, right? So we take a look. All right, bam. Sell price trigger right into the imbalance and then moved off. Okay, because the imbalance, right, works as a magnet. It is also called, we to write this down, it is also called internal liquidity. All right, it's also internal liquidity. All right, imbalance is also internal liquidity. Okay, the market needs what is liquidity? Liquidity is money. All right, that's what causes the market to move. Okay. So the market needs the money to move, right? So it's going to be attracted to, right, those gaps, those areas where it needs to balance the market back out before we get the further push in the market. All right. Everybody following? Everybody got it? All right. We see how price came right away back up. So for example, this was our imbalance. All right. We see how we know how it was created. All right. And this is where now I want to educate you guys now on how imbalance is created. All right. So that you don't just depend on the indicator, but you also know for you. Because whatever reason, let's say, for example, the indicator disappears, somebody deletes it or whatever, you want to be able to know what it is. Okay. So imbalance is created as a three candlestick pattern, right? One, two, three. You look at three candles and you're looking at the wicks, all right? The space in the wicks. If we just have sells, all right, just have sellers in the market, we can see, for example, like right in here, okay, like this wick, boom, yeah, price attempted to come down here and it bought and went back up here. And then right here, this was last buys here in the market. All right, like in this space right here, we had no buyers, none, zero, zilch, right? In this space between here and here, there were no buyers in the market. Okay, so that is where the imbalance was created. Everybody following? So let me know, right? I know as time progresses, realize the responses start to get slower. So if you're sleeping, time to sit up. All right, let's go. All right, cool. So price tends to attract, go to areas of imbalance. Okay. So we see, for example, we know, all right, boom, we got price breaking down below, perfect. Next thing we're looking for is the market to pull back up, right? So we know price broke, boom. So now we know that after the impulse comes the correction. So the only thought process you should be having in your mind now is, okay, how high could this pull back? Where could this pull back to? Okay. And how do we identify that? We start to look for imbalance. All right, I'm giving you guys a simple step-by-step process for this. All right. He's on fire, but he's still there, right? So easy step-by-step process. So we got the imbalance, we got the impulse, sorry, boom. Now we need to know the imbalance. We need to know the correction, right? Where is price going to pull back to? This is how we start to set up our trades. This is how we start to set up our entries. This is how you can get better entries in the market. It requires more patience, but you get a better risk to reward. Okay. So price pulls back up now. Bam. Okay. Straight into your imbalance. Phenomenal. Okay. And then we start to see how price starts to push back down. All right, we start to see how price starts to continue in the direction. Okay, so let me know if everybody got that. Right, so you see here, price pulls back up, boom, and then we push. All right, boom. All right, now look here again. When we just look here again, we see here now, boom, market broke, break a structure, right? And price push down. We got an impulsive move to the downside. Yeah, we got an impulsive move, boom, to the downside. Guess what? All right. And guess what? Maria and Grace having a whole moment there. Like you haven't seen one in a long time. Right? But why y'all see this gap? See this fair value gap here. Here, right? See this gap here, right? See this gap here. All right, so we got price give us an impulsive move, right? And guess what is created? Once again, we see the gap, right? We see the imbalance is created. That's for candlestick pattern. One, two, three, right? The space right here. Again, space right here is created. Boom. All right. So after the impulse, okay, after price pushes down, what we're looking for? We're looking for price to push back towards the imbalance. Okay? We're looking for price to reach for that imbalance. Okay? Boom. All right. So we see how price reached the imbalance, right? No. Perfect. Now, this is what I want to also show you guys. We're gonna get further into it. All right. So price is going to push back up to your imbalance. Remember, that's your area that is attracted. It's attracted to that area in the market for sure. Okay. So imbalance can act as like an area of support. All right. Imbalance can act as like an area of support or an area of resistance. All right. You see here how price came right back into the imbalance and pushed off. Price came here, reacted off the imbalance, came down, but we still pushed up a little bit higher before, right? Before we continue to go down, right? Boom, right? So we started to push back down again. Okay. So everybody following, just follow the concept, right? Follow the concept, follow the principle, right? We see how price is attracted to areas of imbalance. So first, you get the structure. Second, you identify where's the imbalance in the market because that can give me an idea of where price can pull back to, where price is going to correct to. Okay, does that make sense? Let me know in the chat. Let me know in the chat. Okay, good, good. Perfecto. All right, stuff. All right. Yeah, trying to help you guys make this easy. All right, trying to help you make this easy in your mind. All right, perfect. All right, so we see how price pulls back, bang. All right, to your imbalance and so forth. Okay, now that's two. All right, now very similar to imbalance. Okay, because it's twofold, same principles at this point, are same aspect of the market we're looking at, right? So it is whenever we get the impulse, we get the pullback, right? Impulse, we get the pullback. Remember, price could come to, for example, boom, an area of imbalance. But then secondly, market is also looking to reach what we call order blocks, okay? Which are usually, when we write this down, which are usually within supply and demand zones, right? They're usually within supply and demand zones, okay? So a supply zone is where the sellers are at. The demand zone is where the buyers are at. So that's where we get like a strong push, from a particular area. Okay. So where we get a strong push from a particular area. So for example, right? So for example, we see here, shift this, right? So for example, we see here, right? We get boom, strong push out of this area, right? We see the strength of the sellers are here. Okay, the strength of the sellers are here. Bam, market dropped. Okay, and we came back up, right? All of this area here, right? And here, you know, all this area, boom, all right, strong push down. Okay, when market came back into that area, boom, strong push down, right? That's where we can identify, okay, this is where sellers are. This is where the sellers are in control. These are supply zones, okay? It's a zone, yeah? It's a zone. So one of the simplest ways that you can identify a supply zone or demand zone is by utilizing, right? Utilizing the same concept that we spoke about with the fair value gaps. Remember, fair value gap is a three candlestick pattern, okay? So the first candle that created the imbalance, you could use that as your supply or your demand. So for example, this candle right here, boom, yeah, that candle right here, you could take that as, right? You could take that as, yes, you could take that as your supply zone, right? You could also utilize, all right, you could also utilize the engulfing candle, right? Or it is an engulfing candle, really and truly, right? That candle that creates the imbalance is going to be the engulfing candle, right? So Shakira plug in for sure, right? Shakira plug in for sure. So the candle that created the imbalance is that engulfing candle. Now we want to take all of this, all right? We want to take all of this into consideration. So we're going to use the wick of the previous candle and so forth as well. And we're going to take the entire area, all right? So all of this here, this is your supply, okay? This is your supply zone, okay? So for example, this, right? If we had to take this candle, for example, right down here, this would be a demand zone here, right? This would be a demand zone. So for example, you see price tap back into it, boom, you see how market pushed up, right? Market started to push back up over this area, okay? All right, just keep you guys focused. All right, everybody understands? All right, so you look at the candle that created the imbalance, and we use that as our supply. Okay, so for example, here, boom, that would be our supply zone. We take the wicks into consideration, all right? Might as well, they're right here, right? Supply zones, okay? All right, these are supply zones. Bam, bam, all right? Um, they already have an imbalance here, right? But this is still weird, right? This is still weird. Um, we had strength, sorry, in the sellers when the sellers stepped in, right? So we start get a push down, right? We start get a heavy push down into the market. Okay. So those areas, no. So we got imbalance as one area that market could come back to. And two, we know that whenever price trades back up into areas of supply or demand, then the likelihood of the market continuing to push down is very strong, right? The likelihood of the market trying to push down is very strong. So second thing, okay, thirdly rather, all right, you can do either or, it doesn't have to be in this particular order. It could either be supply and demand or it could be fair value gaps, right? But regardless, just make sure you do it. Yeah. So supply and demand. So identify that, all right? Identify that area for sure, okay? Because now this is how it's going to come in handy, okay? So once you've got your fair value gaps in, once you identify the supply and demand zone, now what we're looking at is we're going to look at the order block. All right, so this is how, and you're gonna be able to start do this really fast. All right, it just sounds like a lot now, because obviously we're just breaking down everything. All right, but everything as you realize is wrapped up into one. Okay, so we got the fair value gap. We understand the supply and the demand zone, right, where the sellers are at, where the buyers are at, and then the order block. Now, the order block, we just make it more precise. That's it. All right. So that order block now is the candle that got engulfed. Okay, so we got the engulfing candle, right? Now remember engulfing candles, what engulfing candles look like? Engulfing candles look like let's use clear examples. Boom. You see this candle right here? Can you guys see this? Is it too far? Is it close? Is it good? All right. This candle right here, this big bite-sized candle, that is an engulfing candle. The candle before is a candle that got engulfed, right? Big bite-sized candle, right? Candle before is what got engulfed, right? Big bite-sized candle, candle before is what got engulfed, right? So you do it on the sell side candle, boom, candle before got engulfed, okay? Big sell side candle, candle before got engulfed. Everybody seeing that? Everybody following? Let me know in the chat. All right, bring it all together, bring it all together. Okay, good. So those candles, now we consider those to be the order blocks. All right, we consider those to be order blocks. All right, so we just getting more precise with it. So now we know, okay, this particular candle here, boom, that's our order block. All right, that's our order block. All right, this could be an order block. Okay, all right, and it ties, nicely with our fair value gap. Right, this could be our order block. Okay, this would be our order block. Okay, okay, trust everybody understands. Yeah. So that is literally so those areas have our interest. Okay, those areas have our interest for entries into the market. Okay, those areas have our interest for entries into the market. Okay, now it's in the chat if we are all following. Yeah, it's in the chat if you are all following the stuff. All right, perfect. All right, how can you guys bring it all together? Right? No, I'm not gonna spend too much time on it, but I'm just gonna mention it for you. Right? The last thing that you will look for, okay? The last thing is going to be liquidity. Okay, the last thing is liquidity, right? Remember, we got that internal liquidity, which is imbalance. But we also have that liquidity, right, which is usually found like where you would see areas of like double tops, right, or double bottoms, right, like equal highs or equal lows, right? These areas here is where money is sitting at, okay? The areas here is where money is sitting at. So you see how price, will sometimes run and try to grab the money that is here, right? The money that is there. So, for example, you may see, right? For example, you may see where price may give you a good example. You may just see all right, so two things. One is represented by those double tops, double bottoms, but then you also see liquidity is represented by long wicks, right? And well, long wicks, right? Let me put it like that, right? You also see like long wicks and so forth in the market. Okay. So for example, where you might come and see, for example, price push down like this, and then you get a wick up here, right? And you might think, oh man, I missed the move. But then truly didn't, right? As a liquidity build up. Okay. More price gonna come back. So that first tap back in, right? So we see price pull back up that first time. More likely is the liquidity build up, right? It's liquidity push. So then this move is the actual move to grab that liquidity to then move in the market. Okay. So once again, like here, we see price push down, get that first pull back up, right? This, you see the equal highs that's created here as well. Like this one was very, very, very clear. Okay. Look here, you see here, price push up. We got all these equal highs, all of these long wicks. That is what we call liquidity. Okay, so you didn't miss the move, right? You be thinking, oh man, price come back up here and it started to push down. You thinking you missed the move. No, that's the setup. Price gonna push back up, right? Push back up, grab the liquidity, then we start to move down, right? But that's gonna be a session for I think that one we probably gonna do, you know, a little bit more in depth for you guys to get accustomed to seeing it. All right. But I just wanted to mention that for you. Okay. All right. Anybody got lost at that? Or we still good? All right. That first top box is usually just a liquidity push. Yeah. Okay, cool. That first top buy is usually just a liquidity push. So you don't miss it. All right. You don't miss it. All right. So I'm just keep you guys on track now. So remember, structure. Boom. All right. You go to lower lows, lower highs, break a structure, bam, bam, bam. Next thing we're looking for, Pagadum. Right? We're looking for the imbalance. We're looking for order blocks, supply and demand zone. So literally this pulls up everything for you. Okay. So literally all that is going to be in here. Okay. Only thing I don't have in here is premium and discount zones. You don't necessarily need that, right? You should know that. Okay. The equal highs, it shows you the equal highs as well. All right, order blocks. So you got internal order blocks, and then we got the external order blocks, right? So now, as we look at this, right, of course, the stronger order blocks is going to be that bullish OB, bearish OB. Those, but it stands for order block, right? So all it does is, again, it just identify what we already know. Okay, we know where the supply zone is, all right? We know where the order blocks are. It just identifies where they are in the market. So that's why I said it's good to know because you can have a lot of stuff on your screen. You know what I mean? So we just identify those things. So it's two things. One, price could either just trade off of the fair value gap, right? Which it did right here. All right. So let me identify. So I'm gonna just move this once again. So for example, this was the gap in the market. We see how price just traded off of that gap. This was our supply zone, right? Literally, that was the supply zone, and this was your order block. Okay, that was your order block. This entire area was a supply zone. This was your imbalance. Okay, yeah, I know. You don't necessarily need the premium discount, is what I was saying. All right. So this is your once again, yeah, your order block, your supply zone, your imbalance. So we see how, for example, price just came into the imbalance here and moved. All right. Now in this scenario here, right, we can see once again, um, boom, supply zone. All right. We just take the wicks, everything into consideration. All right. Supply zone. The imbalance was like back down here. Okay. So you see here, no price top into the imbalance, right? But we didn't take that as the move, remember, because the first top back is usually just a liquidity push. Okay. All right. When price tops back in, that's usually just a liquidity push. Created those equal highs, and then price traded higher. All right, price traded higher into the actual supply, right, into the actual order block. Then we got the push down. All right, so you can see sometimes it may just trade into the gap. Sometimes it may go actually into the supply or the order block. Okay, then we actually get the movement down in the market. Okay, so that's literally it. It's pretty simple. Okay, that's how you can start to pick entries in the market. That's how you can start to reduce your risk by getting better entries. Because always remember, we're trying to sell as high as possible, right? We don't want to sell as low as possible. We want to sell as high as possible. The higher we sell, the better it is. The less drawdown you're going to be, the less RTA you're having, the less you're studying trades because you got the best possible entry. You go break even a lot faster, right? You go break even a lot faster and you're able to let a trade go. Okay. So the higher you get the entry, the better it is for you. Okay. So once again, all right, then we start to, for example, you're just looking for the same things for price to break. You're looking for the imbalance. Boom. So now, for example, here you got price breaking again. You see the imbalance. You see the supply. All right. You see the order blocks. Okay. So then you do the same thing. You're looking for price to pull back into it. Okay. To then give you an entry. Yeah. But then you to take price further down. Right. So you see, in this scenario, you see how price didn't create a lower low, right? How price didn't go ahead and create a lower low, right? And also, it's very, very, very important to always know is, and as I say, to always know it, know your external structures, right? Which is your lower lows, your lower highs, right? Like what is, always remember this, what is the high that created the low? Okay, like what's the high that created the low? What's the highs, right? That created the lows. All right, so when price pull back up from here, boom, this is the high that then created the lows. All right, then we have price actually break above these highs. Yeah, I mean, not really. All right, we wicked above. All right, we wicked above. We didn't actually close above. And then our price started to push back down, but we didn't create a lower low. So now we know, okay, yeah, all right, something going on. But we got the same principles in mind. We're looking for imbalance. We're looking at, where price can go to. We're looking for the order blocks. We're looking at the supply and demand. All right, like we literally gonna do the same thing, all right, over and over again. Okay. So you see now here, for example, how price come back up, didn't break the high, right? Like this could sell, right? This could probably push it come all the way back down, right? Because we didn't break the low. We also eventually we didn't break the high, right? No close above. Price could literally start to push back down from here, right? And drop and come all the way back down. Who knows? Maybe we break the low, right? Maybe it goes into consolidation, right? That's the part you don't really, really know, right? So yeah, guys. Anybody learn anything on the session today? Anybody learn anything on the session? Now, for targets, really and truly, what you want to do, start a target. If you're in a supply zone, if you're selling out of a supply, look for the demand. Where's the demand at? All right, sell to the demand. You know, that's because that's where the buyer's at. All right. If you're buying, you're buying from a demand zone. Where's the supply at? Sell to the supply zone, right? Or and look for the imbalance. Where's the imbalance? Because we know those are areas that price target. Where's the imbalance in the market? That's how we target, you know? Because we know price can react off those imbalances. Price react off the inefficiency in price. So we target those areas. Always remember this, write this down. The same way you enter the market, it's the same way you want to exit it. Come on, Seth. Seth, be listening. Come on, Seth. Seth, be listening, man. The same way you enter, the same way you want to exit. Yeah. Same way you enter, same way you exit. Same way in, same way out. All right. Same way in, the same way out. All right. So, yeah, guys, I hope everybody got value from the session. All right. Let me show you example of something here real quick. Trading too hard. It's not. It's definitely not. It requires practice. Hey, remember when we were going to school, we were saying that one-on-one was hard too, right? And then two times two was hard. And then they introduced three divided by six divided by three. And then they introduced square root. and then introduce loan division, and then like, it's not difficult. It just requires practice. If you put it in your mind that it's hard, it's going to be hard. I promise you that. All right, I promise you that. All right, and that's cool. All right, you lost all your money. I lost all of mine 8 times. All right, you just determine now at this point, am I going to learn the lesson or not? You know what's the lesson? The lesson is risk management. That's the lesson. Because it's hard to lose your money using proper risk. It's easy to lose it not using proper risk. All right. It's hard to lose it using proper risk. All right. It's hard to lose it, right? Doing the things, that you're supposed to do. But as soon as you say, because this is the thing, and you will hear me say all the time, the skill of trading is easy. Like what I just showed you guys literally in an hour, how you can break down the market. Yeah. The skill of trading is easy. It is this that is difficult. The mindset. That's the hard part. Right? Because I literally just showed you guys. Like you can look at the market, you see price breaks, it's just patterns. That's it. Right? Patterns. We identify those particular patterns in the market. You get accustomed seeing it. You get accustomed doing it. Like, don't be in a rush to trade. That's why persons lose money unnecessarily. Don't be in a rush to trade. Like, look at this. Start to look at it. See it more often. Right? See it more often. What is it that we do right now that we don't even think about? We don't think about brushing our teeth. We don't think about how we're going to bathe. We don't think about how we put on our clothes. Why? Because we do it every single day. Same thing. Practice. We don't think about driving. Like, have you guys ever got into your car and drove to a destination and you didn't even study like how we got here? It's only afterwards you be like, yo, how we get home though? Right? Because you were just driving. We don't think about it, right? We don't think about it, right? Janelle just broke it all the way down. Market structure, imbalance, order block, supply and demand entry. Bam. That's it. That's the entire ball game right there. Must remember it's practice, practice. Don't go insane. It is hard. All right. What's hard is me and you. That's what we're gonna get better, right? The indiscipline, the fear, the greed. That's the hard part. Everything else ain't hard, right? But those are the things that are hard. When the trade going our direction, the hard part is not closing that trade. All right. The hard part is leaving it. All right. The hard part is seeing profits and actually taking it out. That's the hard part. The hard part is not, the actual breakdown in the market, right? We hard. The actual skill, I just brought that down. Literally, it took me years to learn that. I just give you guys the whole ball game. All it takes now is practice. So now the question is, are you going to practice it? That's the question. Despite how hard it is, it's hard the first time. And then when you do it again and again and again and again and again and again, it gets easy. Right? Like I could never compute, right? How how my plots here. I'd be like, bruh, from a child, right? I see them fingers. I always wonder this. Girls would say that girls don't have much hand-eye coordination. I just don't know what be going on. Right? But I was young. I was like, how y'all can't catch a ball but can plot here? Y'all fingers be like, what? But what happened is that come with practice, right? That come with practice. It's like we practice catching balls, then practice clocking here, boom, 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 boom. So it become easy. So it's the same thing. If you practice it, right? If you practice it over and over and over and over, it's going to become like second nature, right? Cooking. Some people phenomenal at cooking, right? So the girl, like, talk to me real quick. What you great at? Like, you could say hands down, I am phenomenal at this. Whether you're a chef, whether you could cook, nobody can, make a macaroni pie like you or sweet potato pie. What you good at? Talk to me in the chat. Talk to me in the chat. And this for everybody too. You know what I mean? Like, what identify something that you are great at? I want you guys to drop it in the chat. All right, boom. Janelle says she is great at teaching. All right, Michelle, she's great at cooking. All right, what's some food? All right, let me see. What else you good at? Talk to me. When it comes to Lucia, all right, yeah, I know. You're licking Michelle. All right, Shanice, cricket. Shanice is a cricket. All right, Shanice, big itself. All right, Shanice is great at cricket. All right, Sophia is good at soup and sweet bread. Sophia, we need sweet bread. I'm a soup fan. I'm only a soup fan if it got dumplings. Right? I don't deal with soup, bro, like that. Like, I just feel like soup is just drinking water. You know
Wait,
what I mean?
wait, okay, okay. What
You know what
soup?
I
What
mean?
soup don't got dumplings? This is like restaurant soup.
Bro, I don't know, fam. I don't know. I don't know. But the
It's
soup, it
dumplings,
gotta be
fam.
packed with dumplings. It gotta be packed with dumplings. So let me see. So the girl says she's great at shopping. Oh, wow, okay, all right, good. Right? How is be great at shopping? I mean, I guess you might be a great shopper. Okay, all right, phenomenal, right? You're a great shopper, right? Making things, anything you might have is perfect. Finding solutions, problem solving, phenomenal. Banana bread, cheap. All right, all right. I like banana bread. Making a mental note. All right, I'm making a mental note of these things. All right. So what else? Respect us to mess and then with up our day. All right, shopping for sure. All right, cool. So what's this? You got great at these things. How? Put in chat. Tell me. Tell me. You got great at these things. How? Over time, but how? Because what's this? Time can pass. That don't mean you're gonna get any better. How you got better? Practice, repetition, repeating, feeling and getting better, making it over and over. How do you guys get great at shopping? In the chat, let me know. Right, trial and error, repetition. How did you get great? You didn't get great over time, right? Time has nothing to do with it, right? Because time can pass and we can remain the same, right? Because we get older, don't mean we get better. Because time pass, because you are in trading for 6 months, for 6 weeks, for 6 years, the time doesn't matter. It is what you put in the time. That's the repetition. That's the mistakes. That is the flowing accounts. That is the intentional time of getting better. That is how you got great at what it is that you do. That is how you became a great teacher. That's how you became a great cook. That's how nobody can shop like you. That's how nobody can make a soup like you. All right. That's how nobody can make banana bread like you. Right. That's how nobody can, solve problems like you because you've been doing it over and over and over again. You have built the muscle, right? You have built that muscle of consistency, and consistency will yield to you getting better. Yeah, it's not. People say practice makes perfect. It isn't. All right, practice it makes permanent. All right, practice makes permanent. Right. So if you practice the wrong things, you will permanently do the wrong things. If you practice the right things, right, over time, okay, over time, you actually get better, right? Over time, you actually get better. If you practice the right things, then the right things comes easy, right? Here's the way it goes, right? Oh, here's to write this down, right? Here's where it goes. It starts with you being consciously, my wording says so, my spelling ain't coming to me right now. Conscious, how you spell conscious? Conscious. All right.
You got ask before they see. You ain't got ask in
You
there.
got it.
Wait,
Yeah.
hold on.
And I'm looking a little funny here, boy. All right,
We
here's what
know
we're
what you
gonna do.
mean. We know
All
what
right,
you mean.
watch this. Become conscious. I said missing the S. All right, no worries. This is what conscious. Yeah, boy. See what? Anyway, watch this. Right, become consciously competent. That's where it's gonna start. With you becoming consciously competent. Right, right. You're gonna become consciously competent first. Like it's like, all right, yeah, this is how you do this, then you do that. You're conscious of it, right? Then you're gonna move from being conscious of it to being unconscious, right? You're gonna be unconsciously competent now, yeah, where you get to a place, where it's like, okay, when I look at a chart, right, I don't need to go and drop everything and do higher highs, higher lows, et cetera, et cetera. I don't need to do all that because I can look at this chart, for example, and see, okay, gold made a high right here, right? Boom. I can see, for example, right here, this was a demand, right? Then I can look here at this chart and I can see price created equal lows. Boom, that is liquidity. So then the market came back, right? Tap, tap into this area. Boom, sweep the liquidity and then bought. That's unconsciously competent, right? I just look at the chart and I can see that. Okay. Price created equal lows, swap liquidity, bought, no pulling back, right? The likelihood of this buying is definitely there, right? Because price break, right? Break, boom, right? Pulling back down into this area. We gotta see what's going on here at this point, but price trading back down into this same area of demand. Okay. So you become unconsciously competent. Okay. And then you know what happens? Then you switch back, right? Then you switch back to becoming consciously competent to teach it. That's when you go to another level, right? It's like you become consciously competent at the beginning, very beginning. You are consciously incompetent, right? All right, I don't know, right? It's very start. I know that I don't know, right? Then I move from knowing that I don't know to knowing that I know, right? It's like, all right, cool, boom, I learned the skill, bam, I'm competent now. Yeah. Then I get to a place where it's like unconscious. It's like I just do it and I can't teach it. I don't know how, right? That's the place you get to. I don't know how, but I just look at the chart and do it. I can't explain it. I can't teach it, but this is what this happened for me, right? And then you go to another level when you actually are able to teach it, right? Because you know a thing when you can teach it to somebody else, right? That's when you go to the next level because even in this teaching, what do you guys think I teach? I teach. I teach for you, but I teach for me too. Because when I teach, I be sharpening my skills, right? Because I have to find ways to articulate what is in my head to you so that you understand, right? So that's why I teach. So you become consciously competent once again. So you always flip between those two. Yeah, consciously incompetent and then consciously competent, right? So let me know if that makes sense, right? And give yourself grace, give yourself time, like in no rush, right? Training hard, just give yourself time. You know what I mean? You got better at shopping, you got better at cooking, you got better at everything else over time, right? And because you were intentionally practicing. So don't watch this, right? Don't complain about the results you don't have from the work you didn't do. Make her snappy fingers, right? Don't complain about the results we don't have from the work we didn't do. So if you're not putting in hours on learning, on learning, on learning, right? Right? And and we complain about, man, I don't have this type of results and so forth. Nah, 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 nah. Mm-mm. Two can't go together, right? Two can't go together, right? You got to put in the work, you got to put in the effort, you got to put in the time. Remember the session we did, that mindset session we did, guys, right? The variable that you control is you. Trading in hard, switch perspective. So you got to get better, right? Trading hard because there's thousands of people across the world that trade. There's many people across the world that become multimillionaires, right? There's so many people in the community that get a result. So if so many people in the community get a result, right? If so many people in the community get a result, it's like, all right, I gotta get better. So then what you gotta do, Susie, you gotta get better at not cutting the trade too early. Practice. Right? Practice. Right? That's a muscle that gotta be built. Right? It's patience. Yeah. It's patience. Yeah. So then you gotta get better at not cutting the trade too early. How do you get better at not cutting the trade too early? The same things that we just went through. Remember, same way you exit the trade, same way you enter the trade is the same way you exit the trade. All right. The same way I enter the trade is the same way I exit. So if I see a thing happening over over for me, you know what's gonna happen? Then I don't panic. I don't trade because, for example, right? I know that when price reaches a certain area, right? When price reaches a certain point, right? I know this particular thing is going to happen, right? So I don't panic. I don't jump out of the trade too early because I know it is just a pullback and not a reversal, right? I know, for example, like this, when market does like that, it's just a pullback. It's not a reversal. So I don't panic. I don't jump out the market so early because I know from here now is upside movement. Because we know impulse, correction, continuation happens in the market over and over and over again. All right. All about killing me. Just practice. Just practice. Just practice. Just practice. All right. Get this. See this? Replay tool. All right. Correct. All right. See this replay tool? Get the replay tool. Because now you're able to sit, even if you got to sit down and watch the chart. All right, sit down, watch the chart. He's like, all right, let me see what actually happened here. All right, if I get in the market at this point, let me see what has happened. And I'm seeing it much faster, right? I see a break of structure at this point here. Boom, price break, price give me that impulse, price pull back. All right, let me see what has happened. Boom. All right, whenever it break, market can start pull back. You know, so we just look and see like how the market moves. Gotta get accustomed. Right? I'll spend time going through it, working on the craft. Right? All right, guys. So that was a long session. Many of you made it to the end. Forgive yourself because you got value. Um, we're gonna be back on Thursday once again. I want you guys to take the week, and apply. Yeah, it is Monday. Application. Apply what's going on. Apply what we went through. I got the chart. See where you can find the imbalance. See where you can find supply and demand zones. Right? Look at the breaker structure. Boom. Pick your entries. Pick your entries. All right, guys. So definitely got value. Perfect. Good stuff. Good stuff. Right. And like Kurt said, you can post the charts. You know what I mean? Like we got the community, drop the chart in the chat, drop the chart in the main chat. Hey, you're looking at XYZ, boom, boom, boom. Like is this the imbalance? Is this the fair value gap? Is this the supply or demand zone, etc. This is where I'm looking to target. All right. This is where I'm looking to target, like is that a good target? Can I target further? All those different things that you could do as well. Yeah. So because of value, you're most welcome, Susie. Good session, good session, awesome, awesome, excellent session, good stuff, good stuff. All right, guys. So with that being said, see you guys on Thursday. All right, we're gonna go through some more stuff, man. Maybe we spend more times on exits. All right. Yeah. So have a good one, guys. I learned a lot. Glad to hear that. Glad to hear that. All right. Let somebody know, man. Thursday, they need to be on the session. Don't stick up. All right. Make sure they plug in. All right. Have a good one, guys. Be blessed. Peace.